My name is Nick Randall. I'm the CEO of FreightCar America. With me also is Mike Reardon. He is our CFO. For any questions we have later on, but feel free to stop me, ask me questions as we go through this. But I'd like to spend some time introducing you to FreightCar America, or those who are familiar with FreightCar America, talk a bit more about what we do. So we have our normal forward-looking disclosure statements. Who are we? We are going to have a 125-year anniversary next year, so we're a long legacy manufacturer of North America's rail car. We're a pure play freight car manufacturer, which is different to our competitors who usually do leasing and manufacturing. We're one of the few pure play manufacturers. I do like the first bullet point, the fastest growing OEM, given the market that we're in. We are being able to grow pretty sizable over the last couple of years. We do have a unique ability to build new products, retrofits, conversions, and rebuilds. Heavily vertically integrated in our manufacturing facilities, in our purpose-built manufacturing facilities. And because of all that, we're able to deliver strong margin profile, cash generation, and support long-term margin or value creation. Quick look at some of the numbers. This is the trailing 12 months as of 9/30 this year. So just under 4,000 rail cars shipped. Generating just over $12,000 of EBITDA per car shipped, per rail car. Put that into contrast, our last time we manufactured a full year in the US was 2019. And in that year, we lost $18,000 per rail car shipped on about 4,000 units shipped. So we managed to turn the business around at the tune of about $30,000 of EBITDA per rail car shipped. Spread that across 4,000 rail cars. You can quickly see how significant that turnaround was. Adjusted EBITDA margins just over 9.4%. Installed capacity right now of 5,000 units a year. Adjusted free cash flow of $22.3 million, and revenue just over $513 million. Revenue is a bit of a difficult thing to measure us on. There's a huge variability between a retrofit or a rebody and a new car. The revenue can change wildly, but the profitability stays the same. So, which is why we try and focus on adjusted EBITDA per rail car or adjusted EBITDA margin, main drivers for us. To see it graphically over the years, how we've performed on revenue since being in Mexico, significant growth over that period in deliveries and revenue, and you can see the adjusted EBITDA that goes with it, going from a loss in the earlier periods to sustained profitability in more recent years, and again with guidance for the rest of this year, continuing that trend. Well positioned in the market, the rail industry is generally 40,000 units of rail cars across North America. It does include Canada and Mexico, the lion's share being in the United States. 40,000 units is derived from about 1.6 million rail cars in use across the North American network. They are mandated to be removed from service by 50 years. The vast majority are removed from service. Sorry?
In how many years?
The vast majority, they're removed after 50 years, 50 years of service. The vast majority, somewhere between 45 and 50 years. So if you look at, that would be about 50,000 units scrapped off per year. Each new units built today are slightly more efficient to the ones we replaced 50 years ago. So that gives us about 40,000 units per year. And that number's been pretty consistent over any given 5-year period for the last couple of decades, even with shocks like COVID, Great Recessions, and financial crisis. The average over any given 5-year period pretty solidly sits at that 40 units. We then break it down by the different types of product. So open top hoppers, market leader. These are a typical product that moves a limestone crush or a sand or an aggregate product. We have some really clever gating systems that allow that to be emptied almost instantaneously at the end-use facility. And because of that, we can command a nice premium because we have a very differentiated product. Gondolas and flat cars, these are really the mid-range workhorses across the industry. We have really great products in both gondolas. Flat cars marked as a significant growth opportunity. Within the flat car market, there is intermodal and there is highly customized flat cars for maintenance programs in railroads. That's where we do a lot of great work with our customers by designing and configuring cars unique to their ability, and then producing those cars in our facility. Covered hoppers, by far the largest segment in the rail network. About 40% of all rail cars are going to be covered hoppers. These are the ones that harvest grain or fertilizers or all to do with the agricultural process. Given that North America constantly needs to be fed, it's pretty resilient to any economic swings in there. Boxcars, we have boxcars. We typically let other people build boxcars. They're a very commodity-driven process, not particularly lucrative for us. But we have built some when we partner with other product portfolios. And then tank cars, these are fluid vessel cars, currently not in our product portfolio historically. We have two-step programs, a retrofit program that kicks in 2026 and 2027. We'll convert existing tank cars, about 1,200 units of them, to the DOT standard 117R and have those returned back in service, fully compliant. And in doing so, we'll have our facility and our designs fully approved by the AAR, which allows us to start shipping new tank cars from calendar year 2028 onwards. And that's in addition to the cars we already produce. We'll be targeting about 10% of the 10% market share of the tank car market, or about 800 to 1,000 units to add on to the product portfolio we do. That puts us in a really good position, both from a product portfolio, but also being able to balance demand cycles across multiple years with our manufacturing process. Diverse product portfolio, just as I talked about, you can see all the different types of gondolas that we do. The hoppers, open top and covered flat cars, conversions and modifications. Conversions is really big for us. As I said before, cars can last 50 years, but most body sides on a car won't last 50 years due to the use and abuse and fatigue and corrosion. So quite often customers would send back, or we'll work with customers after that sort of 20 to 25 year period, take that rolling stock back, strip down the body sides and rebuild new body sides on it. That's what we call a retrofit or a rebuild. The revenue is significantly less because so much of the parts are reutilized and recycled, but the margin dollars are the same. So for us, it's very lucrative work, but that's why our revenue can show swings, even if our profitability shows growth. On the right-hand side, a breakdown of the market share by principal customer group. So we have three main groups. We have the Class 1 railroads. They're about a third of the market. They buy and utilize their own rolling stock. We have the shippers and closed ecosystems. So these are people who own ports or mines and use their own rolling stock on their own ecosystem. Or we have the lessor group. These are mid-tier leasing companies, banks or investment funds. And the reason why we managed to grow with them faster than the rest is because our biggest competitors are leasing companies who manufacture. We're a pure play manufacturer. So when we're selling to other leasing companies, we are not their competition, which gives us a level of customer intimacy which our competitors struggle to match with. And that allows us to win work rather dictated by price. We can win work on value proposition and fit for purpose for the end users. Pillars for value creation. So obviously we've got a very vertically integrated manufacturing platform. It's based in Castaños, Mexico. It's about 1 million square feet under roof. We use about 750,000 square feet currently. There's a fifth manufacturing line under roof ready to turn on under 90 days as customer demand might dictate. We have about 2,000 trained workforce. These are skilled welders, fabricators, and metal workers in our facility in Mexico. A world-class facility that drives operational excellence on a daily basis. Because of our vertical integration, because of the drive on productivity, because of the stability of the workforce, we're able to deliver industry-leading margins both on our product and then on a byproduct across our product portfolio. We have an optimized capital structure. One of the main reasons why we moved from the US to Mexico, not only was access to labor and the stability of labor, is that when we were in the US, we had far too much capacity and our fixed costs were far too high. When we purpose designed our facility in Mexico, we optimized it that we could run profitably and successfully in a downturn, but also scale up with customer demand. So a large proportion of our costs is variable, not fixed, which allows us to scale up and ebb and flow with the customer demand. And then future product expansion. I mentioned before, we do have a contract to build or retrofit tank cars over the next 2 years through 26 and 27. We will have certifications to build new tank cars from 2028. And by the time we finish that, that will round off our full product portfolio. In addition to that, we're expanding into the aftermarket parts and services across the United States, where we're able to service the cars that we put into the fleet, principally the aluminium-based coal cars, of which there's 400,000 of them in use, and then a distribution network of components and parts for consumables used across any type of rail car. So why are we uniquely positioned? Our flexible manufacturing campus, so our physical campus is longer than our competitors. We've extended it by about 30%. What that allows us to do is to run multiple production lines in parallel so that the time to change over from product A to product B is grossly reduced. Typically, a changeover can take anywhere between 8 and 12 weeks across the industry. Ours can be done in days. So it allows us to really sort of take out that downtime. We have a product portfolio that grew organically. So a significant portion of our design DNA is shared across multiple products, which allows us to interchange componentry and elements of a rail car between designs, both from a supply chain, days working capital, and an agility perspective that allows us to outcompete all of our competitors. Integrated product platform, so we do have our own fabrication shop, weld shops, weld training, so principally our raw material is going to be coil and plate that's shipped into the plant. We convert and transfer that into a fully functional rail car. And then industry-leading technical expertise, both from our legacy of almost 125 years old, understanding rail cars and the use of rail cars and how to design rail cars. We apply that to every rail car we ship. That transfers into a lower cost of operation for the end user, and we believe a higher quality product and a trusted partner with our customers. So quick look at our 2025 guidance. It's pretty late in the year now, so we have just over 7.7% growth on railcar deliveries. You'll see the revenue goes down, even though EBITDA goes up, and that's more to do with the product mix and to do with higher percentage of conversions, which are equally lucrative for us, and holding our guidance of somewhere between $43 and $46 million of EBITDA, about $46 million at the midpoint. And with that, I'm going to pause for any questions that anybody may have for me, or any questions for Mike. Yes, sir.
I was hoping you'd have some pictures. I'd love to see how the casing or whatever you call the wheels, with how interchangeable you're seeing. That gives you a big advantage, flexibility, but I can't visually see it. So, yeah.
So if you imagine it,
and to add to that, you don't call them wheels. What do you call them?
we do call them wheels.
Do they wear out also? I mean, the tracks that debris gets on the track, do they wear?
Yeah, especially if they're uneven braking as well. So uneven braking probably puts more flat spots on wheels, so they'll be returned and reground. We don't do that. That's an aftermarket service people do. But typically, just to your first question, whenever you design a product, the later in its build life that you can customize it, it's usually called the pizza principle, that you have the same dough, the same tomato sauce, the same cheese, and you just put the toppings on last. If you can do that in manufacturing, you can be more efficient. So we do the same thing with our rail cars. So a covered hopper and an open top hopper. So a covered hopper is, the hoppers are in the middle lane. So those two cars that look visually different at this slide share about 80% of the same product type. So from the wheels, the trucks, the castings, the chassis, the subassemblies, they're all going to be exactly the same components. And then what happens at the last minute, it's the body sides are different, whether it be stainless steel, aluminium, or a different product. So when we're able to share that through, just think from the supply chain, rather than trying to manage 5,000 components, they could just be managing 1,000, but 5 times better. And then from an inventory and from an agility perspective, it allows us to keep supplying those synchronized materials in manufacturing quicker.
So you don't make the wheels, somebody else does make the wheels?
The wheels are bought. Someone else casts the wheels. Yeah. Typically, there's 2 major providers of the wheels. The customers usually spec which package they want of the wheels. So about 40% of what goes onto a rail car is what we call specialty, which is there's a dedicated supplier who makes it, like a wheel or the castings, just to maintain control and consistency. Our specialty comes in the fabrication and assembly of the rail cars. Yes, sir.
Do you foresee any loss of pricing power if the major railroad merger is approved?
Not to us, maybe to the leasing community. I think that's where it'll turn up, but less so on the manufacturing. We're probably too far removed from the railroads negotiating power. I mean, they've got a lot of negotiating power already. I don't think when they merge together, they'll have any more. They've already got a pretty strong negotiating power. What I say, we try and avoid having conversations on purchase price per unit. It's the value cost of the life cycle cost of the product, where it's much better to talk to the Class 1 railroads in this case and find out what their pain points are through the life of the product, and then for us to design or to configure that into it, and that gets away from a purchase price discussion and more to a life cycle cost discussion. Yes, sir.
Two-part question, and I'll try to throw that time. But the first one is, how is it the tariffs going to impact your overall revenue, the bottom line, kind of from that
Yep.
standpoint? And part of that is, how does the retrofitting part of your business, is that outside of tariffs since you're kind of refurbishing something?
So we are exempt from tariffs as a manufacturer. So a couple of reasons. One is we're covered under USMCA, so USMCA doesn't attract tariffs from that. Rail cars are international vessels of travel, which don't have duty on cross-border duty anyway. And then we source our raw materials, principally steel, from the US, and it stays as a US-owned inventory and goes in an import-export, temporary import-export to Mexico to be fabricated. So there's 3 different layers of protection there. They're all pretty robust. Even if USMCA went, the other 2 are still pretty robust. So we're not subject to tariffs from that perspective, so not directly. So then whether it's a rebuild or a new car, it doesn't make any difference. I don't know if we're the only one who purely sources our material from US, but not everyone does source their materials from US. So for us, we're okay. And we source it more from the US prior to any mention of tariffs, more to do with supply chain resilience and agility rather than pure price. Because a lot about being able to drive world-class manufacturing is keeping your inventories really, really low and having that just-in-time delivery process to control quality. So for that reason, we have our supply chain based pretty much on the Texas-Mexico border, and it's a 2-hour truck ride away to get most of our materials. No problem. Yes?
I saw a few other competitors in this space. Are any others also like 2 hours from the Texas?
So yeah, there's 4 railcar builders of note. 3 are public, 1's private. The private one's based in Canada, so I don't know all about one, other than it's got Canadian costs. The other 2 public companies are both based in Mexico for manufacturing, like we are. They have facilities pretty much in the same town as we do, plus some other towns. So 95% of the rail cars used in North America are built in Mexico, about 3% built in Canada, and then there's 2%, a long tail of small mom and pop shops that maybe do 1 or 2 units a year, usually prototypes of various things. But yeah, 95% are built in Mexico. Ours is a 20-year newer facility. We were late to go to Mexico, but that helps us because our facility is 1 or 2 years old, not 25 years old at the moment. And then we learned a lot of lessons from that process with physically longer assembly halls, so we can do better or more efficient changeovers. And then we've been able to Even though we've been in Mexico for 3 or 4 years, the vast majority of our employees have been building rail cars for 10 or 15 years. So we're able to have the experience come from the employees to help us build some of the best rail cars. Yes, sir.
Your symbol, rail, was the largest short-line railroad company in the world. How did you get the symbol? Or did you take that company over?
You know, someone asked us a similar question today.
Because rail status was Boca Raton, that's all.
Right. And there was one called RRA and RA. So I found out this morning that we did our IPO in 2006. So
And
it's,
as rail?
yeah, yeah. So I don't know who used it prior to that, but it wasn't through an acquisition. It was through our IPO, FreightCar America, and we got the
A company
rail
called
stick.
Rail came out of Boca Capital
Okay.
30 years ago, and it was the largest short-line railroad system in America.
It wasn't us. Any other questions?
5 minutes remaining?
Thank you.
Nick, can you just talk a little bit about the, you already have, as the growth drivers, I mean, in terms of not only might you see some capacity addition down the road, but also the margin expansion with the entering the tank car market?
Sure, sure.
Are there any opportunities to make acquisitions or enter any ancillary businesses, whether that be fleet management or, or the parts business?
So let me break it down step by step. So first of all, the product portfolio. So the blue bars represent product portfolio that we currently do today. And if you look through our earnings calls, you'll see that our manufacturing margins sit around about 13.1% on the blue product types. Tank cars are industry-wide the most lucrative products, so margin-rich products in the industry. So we are manufacturing leading margin without the most lucrative product in our portfolio yet. So when we think about adding tank cars, we're expecting that to come in accretive to margin at the mid-teens or higher. And then the average selling price of a tank car is about 60% higher than the average selling price of a standard rail car. So a standard rail car, think of about 110,000, maybe 115,000 average selling price. A tank car is going to be about 170. So not only do you get a higher portion of margin, a higher percentage margin, probably plus 4 or 5 points on the margin, you also get plus 60 points on the revenue. So you're going to see that accretion go straight down to the bottom line from tank cars. So that's why it's such an important addition for us to put into our product portfolio. And we have conversions first, then new tank cars in 2028. So that's the main growth on our product portfolio. And then on the aftermarket, you mentioned, Mark, is we have 2 sources of revenue. By far, our biggest revenue currently is on new freight cars. That's our biggest revenue generator. But we do break out our revenue of the aftermarket and components and parts. And in aftermarket and components and parts, there's a couple of different revenue streams. So one is there's an installed coal car base of about 400,000 coal cars that are used across the US. We built every single one of those. And because they're our product, we provide the consumable or replacement parts to it. They're all custom made. They're all I'm going to say handmade, but they're machine made, custom made, bespoke to order. So they're very margin generous, if they'll put it that way, from a coal car. So that is one thing we'll continue to pursue. The second one is an OEM. We get OEM purchasing price on all the consumables that go into any rail car. You're thinking through the brake shoes, the disc pads, a whole bunch of stuff. Most of those OEMs don't like to deal with lots of customers, so they're quite happy to sell to us for us then to redistribute it through. So we have a distribution footprint which will continue to grow. That's more of a geographical growth to sort of be near the rail cars. And then there's a sweet spot when those two things overlap, which is what we call services, where we work with customers on either reconditioning components. So a customer brings a rail car in for service. Some parts get taken off. Those parts get reconditioned, and other person's reconditions get installed. So we do this exchange program, which allows us to rebuild and reconfigure, recondition components and parts. And that for us is a sweet spot because we have the OEM knowledge, we have the OEM engineering skill set and original designs, And then we have the service offering and the production manufacturing skill to manage that process for our customers.
With more than 6,000 small and micro cap companies listed, if you're looking for the next Apple, then Channel Check truly is your tree. It's an investor community where you can access independent Wall Street research, advanced market data, balanced news, corporate videos, and podcasts. You can even register to attend in-person Meet the Management Series luncheons, and to be part of the preeminent annual Small and Microcap Investor Conference, NobleCon. And here's the best news. Since Channel Check is sponsored by the featured companies, premium membership requires no investment. It's absolutely free. So check it out. Log in today. Find out why Channel Check is North America's leading source of research on the companies that just may change the world.